Yeah, we had 63.50 in our bull case, and we kind of talked about that in the last time we were on the show, and I think the other ones, but that we thought if a Republican sweep occurred, which was the most likely outcome, we could probably trade 6,100 probably before year end. So we're right there. Can we get higher than that in the near term? I think it's going to be hard, but yeah, we're marching higher. I mean, this outcome was unexpected 4 or 5 months ago, and as usual, the markets figured it out, right? So in September, we pivoted more cyclically. We got a little bit more constructive on the index for these reasons. And the animal spirits activity, I mean, goes back to what Mike was saying about CPI, PPI. We had the same problem a year ago where, like, when the economy gets going, you get velocity in the economy. That's the thing that can probably hold us back, is if rates start to back up again on concerns, or starts to interpret maybe the Fed can't cut as aggressively, and then the multiples have to come down. But it'll be a stair step, right? We'll get pullbacks, probably be bought. It's a little euphoric right now. We'll have to have some consolidation.
Mike, we still reach 6,000 with rates relatively high. And when we claw ourselves out of earnings season, have you liked what you've seen so far, such that you could even raise expectations into next year? Where's the risk?
Yeah, well, I think the risk, and we've talked about this, it's not a risk, it's an opportunity, is that it's broadening out now. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy. And that translates into better stock performance for the average stock. So the market's speaking.
Wait, did you see my equal weighted chart?
Exactly. But the market's speaking loudly. The one chart that you probably haven't looked at, which I think is the most kind of bullish confirmation that there's a real change at foot, is that gold now is underperforming the stock market. So for the last year, gold has actually outperformed the stock market. And that to me is a sign that the real returns have been sort of muted. And so in the last week, the S&P divided by the gold ratio has gone up by almost 12%. That's an interesting development to me, and it signals that maybe this political change does have lasting implications for what I've been talking about, is this crowding out of government in the private economy, and the government can be shrunk, which is what they're talking about. Then maybe the private economy can blossom. And that's what the market's trying to sniff out. It's not going to be a smooth ride, so there'll be fits and starts, but that's kind of how we're thinking about it.
A lot to dig into there. We've definitely looked at both of those asset classes, but in isolation. Our producer's working on getting that chart. But let's build on what you're saying, that if the government can shrink, maybe the private economy can blossom. Is that a base case? I mean, do you think that will actually happen and you can invest around that?
Well, I think you have to start thinking about it. I mean, the market's already going there. So the question is, do I want to join what the market's telling me? I think you have to have a foot in that, at least 1 foot in that area. And that's what we did in September. We went to sort of quality cyclicals led by financials. That was the real sector that we got behind. But it also includes things like industrials, some small caps. Like, we haven't gone full in on small mid caps only because rates are still too high. And now with this question mark around inflation again, that's harder for us to get like uniformly bullish on smaller businesses. That doesn't mean that smaller businesses can't do better. It's just going to be more idiosyncratic.
So I feel like, did he say his bull case was 66.50? So does
Could
that
you go
mean
higher?
63.50 was our bull case for May of next year.
But do you want to make that now your base case and give us a new bull case?
Well, we're working on that right now. You'll have to stay tuned because we can't talk about unpublished targets. But look, directionally, the market's already gone there. We've been kind of joining in that call for quite a while now, 3-4 months. And like, the more important call, just to be clear, the more important call is not the index. We've said this for a while, is being in the right parts of the market.
True.
And like this year, we've navigated that pretty well, probably I think better than most in terms of being somewhat more defensive in the summer. We got the growth scares, and then we pivoted more cyclically as an example. That doesn't mean we get everything right, but that's what portfolio managers are really doing now. You got to be in the right places. It's not about just owning S&P. We got to beat the S&P.
I remember when you said that on surveillance in April.
That's right. I mean, of all the appointments that I've seen so far, that's the one that offers, I think, the most interesting potential upside. Because we knew that President Trump would be tough on immigration, okay? So the appointments there don't surprise anybody. We know that he's going to be tough on tariffs, okay? So that's not new news. What's new news is how serious are they actually about trying to make the government more efficient? You bring a guy like Elon Musk and Vivek Ramaswamy into this program. I mean, these are serious business people. And, so I think that's exciting. It's going to be a tough road. I mean, our house view is it's going to be tough to actually cut spending. Hey, let's start with freezing spending. Let's try to small wins here. So that's what I'm really focused on, because from an equity market standpoint, that's the potential for much more upside, not at the index again, but for the average company. If we can get the government sort of out of the hair of the entrepreneurs in America, boy, that's kind of an exciting story, potentially.
Well, Mike, let's go down this road. Let's build that hypothetical path. Let's say that DOGE is successful, that they manage to freeze spending, cut back spending, improve efficiency. What does that mean for the economy, and what does that then mean for the stock market?
Well, that's the tricky part too. Is that this? I mean, look, this is a Herculean task. Okay, it's been tried before, by the way, and it's run into roadblocks. In fact, I think in Trump's first presidency, they tried to go down this path, kind of gave up in the end, and the government continued to expand. So, because it's exhausting. So it's going to take time, and the path from here to there probably means slower growth in the short term, right? If you shrink the biggest growth driver, the government, what does that do to the overall economy in the short term? So there's a lot of unanswered questions. We have no details, as usual, at the beginning here. But once again, this is an area where we're very focused on, and we're going to have to key off headline announcements, and then we're going to see what they can actually get done, whether it's the first half of the year, second half of the year, how long it takes to play out. So a lot of unanswered questions, but to me, this is the potential for a big surprise where we have to be open-minded to.
I mean, the question is, which we won't answer here, or this year or next year, does Donald Trump care about his long-term legacy enough to risk his shorter-term reputation? I was looking at a chart that our producer in London, Daniel Curtis, gave us this morning, showing that stock and bond yields have hit parity. And I was thinking, with the policy uncertainty, do you go into Trump 2.0 with a stock portfolio, or is it safer to bet on bonds?
Well, going into the election, we felt like this is the outcome, that basically if Trump won in the Republican sweep, that stocks would do better than bonds, and that's basically played out through the fall. So the question is that fully priced now? In the short term, it probably is priced, meaning we got the easy part of that trade is kind of behind us, and now it goes to the stock level. And clients that we speak to are in the same boat. So initially what they do is they buy futures because I don't really know what to do exactly. And now what they're doing is they're just topping off existing positions. So if you look at crowded positions, they've continued to do well. It's like continued momentum on that trade. But then as we get into December, people will start thinking about next year. And that's where we take a break. We'll take a break, and then we'll have a new theme, a new idea it's totally away from politics, right? The market needs a new idea, a new theme to gravitate to, which, by the way, is one of the reasons why we're seeing some of these crazy moves in speculative areas, right? People are making money in crypto, as an example, and then they're funneling it into like the next hot story they're hearing about on the internet, or they're from their best friend or whatever. That's a little frenzied at the moment.
Well, when we think about the stories of next year, you think a lot about taxes, and the debt to GDP ratio today is not the same as it was back in 2016. The tax cuts, or at least the extension of the 2017 tax proposals here, do you think that now that we have a red sweep, is just a sure thing, or is there some discipline there to keep some of that from rolling off?
Yeah, and do they lift the SALT cap and make it retroactive very early next year?
Well, the retroactive isn't happening, and I wish. But what I would say is, I think you're totally right. We've written about this too. This is not 2016. We don't have the slack in the balance sheet or in the economy itself, in the labor markets, particularly if we're going to reduce immigration and deport some of the folks that are here. We don't have that slack. So if they try to really push the envelope on increasing spending and reflating, inflation is going to become a problem really quickly. So they have to be careful about balancing. Okay, we're doing some cost cutting. That's great. Maybe then they could cut taxes a little bit, but I think you have to do more. Like I would freeze taxes. I would maybe extend the TCJA and then call it quits. But I'm not in government. But I think that the markets will respond much better to fiscal discipline on both sides, both taxes and spending, as well as entrepreneurially favorable policies.